Hey there, friend! Welcome back to the Closing Chapters podcast, where every mission has a story. It could literally blow up a deal if you don't know about it and understand how it works. Hey, friends! Welcome back. I'm so glad you're here with me. Today, I want to talk to you about something that's going on with one of my clients in live time, and I want to explain to you why it's important for me as the real estate agent to have an understanding of different things that have nothing to do with actually negotiating the house, so to speak. It's one layer further. And it's just because I have a little bit of general knowledge about something different that it's helping me in understanding and being able to explain to my client ahead of time what they might be up against. And I'm going to end up showing you how this all breaks out and explain it to you step by step in a little bit. But I want to explain, what do I mean? All right. So, whenever you go to purchase a home, you have two different pots of money afterwards that you're paying. You have your principal and interest, just like a normal credit card payment, a car payment, whatever have you. And then we have an escrow account. What is an escrow account, Brittney? I'm so glad you asked. An escrow account is an account that the lender sets aside and says, hey, I'm going to add a little bit of money into this every month, like a savings plan, and then I am going to pay your taxes and insurance every year. And the reason this is so important is because they have a huge liability in this property. So they are going to be a lien holder on your insurance, just like if you bought a car and they require you to have full coverage insurance and that the loan person is going to be on the insurance as a lien holder. Same concept here. They need coverage to know that if something happens to the house, they're going to get reimbursed for it, right? And then additionally, taxes, right? They don't want the house to go to a tax sale. That would be really sad if a house got sold for $100 just because taxes weren't paid. So they are going to make sure that your tax bill is paid every year for you. And this escrow account can ebb and flow. It can change each year depending on what those bills end up being. And this is where we have to have an important discussion. There are some states that have differences in their taxes. South Carolina happens to be one of them. You have a primary residence tax break, essentially. They also have a homestead tax for people that are above a certain age or have lived in a property a certain amount of years. But for the primary residency tax break, basically the property that you live in and claim on the day-to-day basis, you get a lower tax percentage on it than any secondary property. And it's very common in South Carolina to have secondary homes. We have mountains, we have lakes, we have beaches. It's very common for one person to own several properties in the state. So this is a way to give a little bit of a break to the primary home, and then the other properties stay and are maintained at the normal tax percentage. Okay? So you say, okay, no big deal. There's a difference in taxes. Yeah, but it is a big deal because it could literally blow up a deal if you don't know about it and understand how it works. Whenever we are looking at this tax amount, if it is not in that lower bracket that's for a primary residency, then your escrow payment could be much higher than you are anticipating. And we have to have a certain debt to income ratio whenever we are getting a loan. And this escrow account being higher, sometimes if someone is tight there, it can bust their debt to income limit. And then all of a sudden they are no longer approved to get financing. And that is really sad. And that can be found out legitimately like last minute, like the last week before closing. And how horrible would that be to go through the whole entire process, to pay for inspections, to pay for the appraisal, and then all of a sudden find out this tax rate is really high and they are going to use that number for now, even though you can fix it after you close. And because that number is here instead of here, you are no longer qualified for this loan. Now, agents, do you think that could be a problem for you and your client? I happen to think so. So we need to know and be able to navigate this ahead of time. And you might say, it's one piece of the puzzle. You're right, it is. But if you are not privy to this information or not paying attention or looking at it, then you are going to make an error in communication with your client and communication with the lender. Some lenders will understand, yes, it's going to be a primary residence. I know that the tax rate will be fixed and they will allow it to go through at the lower expected tax rate. Most lenders will not. They will not fix it ahead of time. It will happen retroactively. So you will be stuck with that higher cost until you own the home, apply for the new rate, and prove that to the mortgage company. And even then, they are going to give you what you overpaid at the end. They don't just reapply it to your account. They might adjust your payment going forward. So you're still going to overpay for some amount of time, more than likely, while you are trying to get this fixed. So let me show you what I'm talking about. Let me see if I can share my screen here and let's talk about it. All right, my friends. So when we are looking at the spreadsheet, we're going to pay attention to this top portion. All right. So I just took a scenario and said, all right, an average $300,000 home. That is our home value, our sales price. Okay. A first time VA home buyer has a funding fee rate of 2.15%. So we're going to take that funding fee that ends up being just under $6,500. We're going to add that to the mortgage. Most VA home buyers are not paying that up front. They're going to add it into their mortgage. Every once in a blue moon, that can be different though. And I just had that recently, so we will hash that out sometime soon. Let's say they're an average interest rate of 6% and they're getting a 30-year loan. Okay. This is the principal and interest estimated payment, right? Just principal and interest. Now, do we have private mortgage insurance required on a VA loan? No. So we've got it selected as no. If this were like a conventional or an FHA loan, then we would pop that over to yes. All right. We're going to say we're in the country. There's no city tax on this one, just county tax. So our total tax amount typically would be about $1,100 a year. Okay. We're going to say homeowners insurance is probably 90 bucks a month. All right. So in total, if we come over here, then we are looking at our full payment. All right. So principal and interest, 1837.32, plus our taxes for each month, right? So they're taking that 1100 and dividing it by 12, plus our insurance gives us a payment just over $2,000 a month. Okay. Now, if this is at the higher tax rate, this number literally triples. So we went from, hold on one second. I am not going to adjust that yet. We're going to do this. We're going to have a comparison. 2018.99. All right. This is what I love to do with my clients. I pull the spreadsheet up on the screen all the time and we go through all of this. I think it's awesome to be able to show in live time. All right. So 3,300, it tripled. All right. Our payment just went up $200 a month. 200. We went from $90 to 275, right? That's not good, friends. That's not good at all. So sometimes if people are very tight, or what if they only wanted a payment of $2,000 a month and they're like, okay, I can pay an extra 20 bucks a month. That's okay. But they are not willing to pay an extra $200 a month because that's their electric bill, right? That's their gas, that's their water, that's their internet. You've just busted a deal. That could have been totally fine if the tax rate was at the appropriate place. All right. Now let's up the ante a little bit, right? This is for a $3,000 home. Actually, let's go lower. So a lot of times, let's say we're talking about a first-time military home buyer and they're going to be right in a lower price point. So maybe 225. All right. So 225, all else the same. We're looking at a payment of like 1377. And then we're going to say taxes should be $800 a year. Okay. So all in, they're at 1534. 1534.66. All right. Tax rate is not right. We need to increase it times 3. So we're going to take that 800 and we're going to go to 2400. All right. Once again, we just increased by another $100 just because of the tax rate every single month. And that might not sound like a lot, but it is in the grand scheme of things because that's not going to your principal. It's not helping you buy down anything in your house. It is simply going to a tax bill that is not a requirement on you. And if you don't know this and don't know to tell people to fix it, then that can be a big problem. And I want to tell you, like, the rest of this conversation. I'm going to stop this screen share for a second. Okay, so here's where I'm at with it. I had a conversation. I called the listing agent and I said, hey, I see the taxes are really high. Like, what's the deal with that? Like, it's a residential home. Was this a secondary property, like a rental? Or what happened? And she's like, no, she lived there. And I asked her about it, and she had no idea what I was talking about. And I don't know who helped her purchase it. So I tried to say to her, like, you guys gonna fix it? If that's her primary residence, like, why aren't we trying to fix this? So why didn't we try to fix it before we listed it? I was like, that can bust somebody's escrow account. And she was like, yeah, I know. And I was like, and if somebody didn't know about that ahead of time and got all the way through the process and then the deal falls apart because of financing, that's going to suck for everybody. And the agent was well aware and just basically said, I know. However, I asked the seller about it and then left it alone. I don't know why she didn't do it before and she's not going to fix it now. Y'all, this is such an easy thing to make sure that you are setting your clients up for success on both sides of the deal, right? Because, like I just said, most lenders are not going to fix this for you before you purchase the home. They are not going to bring that amount down. So, if you are the owner, the seller, this is your primary residence, and you can go ahead and fix that and make sure that it is correct in the system, then you have a better chance of having a buyer successfully go through the process and not lose financing and one, to stay competitive, right? Like, there's a lot on the market right now. If I have two houses that are $225, $225, I wish, $225,000, and they're pretty darn similar. And one is at the lower tax bracket, and my payment's going to be $200 less a month. And this one is the higher tax bracket, and I know I'm going to automatically start paying more. And I know that I'm going to have to go do more rigmarole and try to get it fixed, and then go through the lender and try to get it fixed. And right, like, come on, you guys, you're creating a whole lot of red tape for no reason, and it's going to impact your sale. So, agents, make sure you are paying attention to these things. If you know that there should be a difference in taxes, look it up. Make sure you are checking the block. When you are running your CMA, you should be downloading like the courthouse retrieval system sheet, like the property sheet on it. You should be looking to make sure the taxes have been paid in full and are up to date. This person owns the house outright. That could be very important. We all know if there's a mortgage on the property, then the taxes should be paid for. But when a property is owned outright, there's no lender to require that payment. So we have to do our checks and balances before it gets too far, and then we are having to fix things in a last minute, chaotic, stressful manner that could have been caught and at least explained and understood from the beginning. So I hope that makes a little bit of sense. Agents, if you want to talk about this a little bit more, especially if you're in South Carolina and like this is a thing for you, and you're like, wait, I didn't know I could look that up, or don't know why it matters. Please reach out to me and let's talk about it. And clients, sellers, buyers, both sides of the fence there, any potential customers, this is important, right? Set yourself up for success. And buyers, you need to know what your tax rate should be and what the steps are to be able to maintain that, right? Sometimes you can kind of like set it and forget it. As long as you own the property, they're going to just let it be. A lot of times, if there's anything that trickles or changes and they get aware of that, then you have to go back and prove it. Some counties are very strict on you must reapply annually, okay? So the best bet is to make sure that you're applying annually, or sending another message and saying, hey, here's my updated LES. Do you need anything else from me? Even if they're not saying you have to apply annually, make sure you have your ducks covered. It is a huge ordeal. Recently, actually, even on my personal property, we had it at the lower tax bracket. We are a military family. We made a change on my husband's LES and it spiraled like, oh, maybe he's not military anymore, and knocked us out of that bracket. And we had no clue until we got this tax bill and it said that it was much higher and that we didn't have enough money in our escrow account. Thankfully, we were able to go back and get it fixed and get a refund for the overage that we had to pay. So, this is really important everyday life, right? I wasn't anticipating that. We had had no problems with it up until that point. But this is why it is so important to check in on these things because a lot of times nobody understands that things are happening in the background that we can keep an eye on or update and make sure we are avoiding a financial hardship in the future. So, please, please, please pay attention to your taxes and insurance whenever you're purchasing a home. Also, most lenders and agents should and would tell you, but just as a reminder, shop your insurance rates, okay? Also, often we just like pick whoever our car insurance is with and we say, okay, like that's our only option or that should be the best option. And sometimes I'll get to closing and I don't have a say in that, right? That's something that the buyer and the lender are putting together. And their insurance is obnoxiously high. And I'm like, you guys, this is like, I mean, there's nothing you can do about it now. We're sitting at the closing table for like right now, and they're paying a year's worth, of their homeowners insurance like at closing. Now, you can always shop your insurance. So you're not stuck with that. So if you are in a position where somebody says to you, Bud, that's really high. Like, did you check your rates? And then you're like, oh my gosh, what do I do now? Go shop your rates. The only thing that's very important is that if you change policies, that you add your lender back on as a lien holder. That is the requirement, is to make sure that the lender is on there at any and all time and that the policy gets updated with the mortgage, right? And then you can get a refund from that other insurance company that had the obnoxiously high premium. So just remember, you are not set in stone on some of that stuff. I know when we are under a crunch and sometimes we feel like we have limited options or limited time to do a whole lot, we just pick what we're comfortable with and go forward. But remember, this is something we can look at and change and update as time goes by. Because sometimes things change too, and they can get more expensive as time goes by, and you're ready to shop around and see what else is there. You can do that. Don't accept something just because it is. Wait until you're told, no, you cannot do that first. So, anyhow, if you have any questions about that, please reach out to me and I would love to talk to you a little bit more and make sure that you have a full understanding of why this escrow account is so important when you're buying or selling a home and as an agent for us to understand and make sure that our clients have a full understanding of this. Also, I'm going to put one more little tidbit in here. If you agents, I'm talking to you, blinders, look at me in my face right now. And this is really important for buyers in particular too. But agents, when you are making connections with lenders, if you are not telling your lender or you are not establishing that every time they give estimates or pre-approval, that they must include an estimated escrow payment with the total estimate, then you are doing such a disservice to your clients. And honestly, if that lender does not automatically do that, they are a disservice to you. Okay? I understand sometimes it's a little bit like hard to go research the information or whatever have you. If you have information you can pass along to them, great, do that. Say, hey, I'm looking at 123 Main Street. Here's the property card with the, what the insurance is at, insurance, what the tax is at currently. And they usually have a pretty good idea of insurance rates because they're doing them every single day. So we're seeing the policies come in and out. Um, they should be estimating that because when you have a client that thinks that they're going to have a $1,500 payment and then all of a sudden it is $1,700, $1,800, they are very confused and very upset, right? And it's simply because they were given the principal and interest payment, not the full payment with the escrow included. And when we have someone that is on a fixed budget, a fixed income, aka military, they're only receiving what they're receiving, right? There's no overtime, there's no standard bonuses. This is their limit, and they have a specific housing allowance that are being given, and a lot of them try to work within that. Then you need to go backwards, right? You need to be able to say, hey, lender, my client only wants to spend $1,800 all in, escrow included. We need to know what we can afford based on that. Okay? So make sure you are really taking care of your folks. This is super important. We are being entrusted to help military families with such a big financial decision, and there are several different things that are changing, and when they go state to state, it varies. So they are trusting us to know what is accurate and appropriate in our location and to guide them in the right direction. So please do not forget how important this escrow account is and the importance that it plays in our role during the transaction. I hope that you guys have a phenomenal day and come back for another nugget of wisdom in the future. Hey, I just wanted to say thank you for being here and listening in on this episode of Closing Chapters with me. I truly enjoy putting this content together, and I hope that you enjoy it too. If so, could you like, subscribe, and share this episode with somebody you know that will enjoy it just as much as you did? Thank you so much.